All right, it's a beautiful evening, everybody. I'm happy to have you tonight in this amazing quiz, and I'm looking forward to your participation. All right, it's been a while. This is the first we are meeting since last week, Wednesday. Okay, fantastic. Looks like 10 years. Okay, yeah, I got used to seeing you more often than not. All right, got used to seeing you. Okay, so there we go. So, what we have tonight is a quiz, all right, to help us get into what we have been doing, but also just to act as a reminder for all of us to be able to participate properly. And of course, there's going to be lots and lots of improvement after this quiz because it's going to help all of us to see areas where we need to improve and where we need to do better. Like always, the winner gets the money that comes from all of us. So the winner always gets the money. So let's see who's gonna walk out with the money tonight. Let's see. So it's good to have you here. It's good to have you, Daniel Chone. Your camera must be on, please. Daniel Chone and Mr. Mwemba. Mr. Mwemba, please. We've been appealing to you for some time now, and you're wasting our time. Your camera must be on. Okay. Mr. Hems. So, guys, thank you very much for coming through. I'm excited about this session tonight because I'm going to be able to ask you a few questions and then you will be able to respond. But of course, you'll be able to explain. So feel free to express yourself. We want to just take a reminder here. We'll be laughing at some of you, okay? Because that's what we do. We laugh at, confused answers. But anyway, it's okay. So, guys, let's get started and let's see how this one unfolds. We need to see how this one turns out and how it unfolds. All right, so there we go. Is there anything else we need to do? Yes, there is. I'm going to ask you questions 1 to 10. You choose a question, pick a number to like, and then I'll be able to ask you a question. You have 30 seconds before you can explain or before you can calculate. All right, so that's all you have. 30 seconds is all you have. 30 seconds is all you have, people. So you have 30 seconds, like everyone else, to make your case. 30 seconds and 30 seconds only. All right, fantastic. So 30 seconds you have, guys, to make your case. 30 seconds and 30 seconds only. No more than 30 seconds. So I'm going to start with all right, fantastic. So just to mention, somebody is texting me that this is from all the topics we've done. So I'm gonna start with I'm gonna start with Mr. I'm gonna start with Mr. Mwemba. Okay. I'm gonna start with blessings. Blessings, you have 30 seconds. All you have to do blessings is simply pick a question between 1 and 10, and then I'll be able to ask you that question. 1 and 10, Mr. Mzamba, your camera must be on, please. Your camera must be on. So you have 1 to 10. Pick a question from 1 to 10, and I'll be happy to ask you. So let's start with blessings. Blessings, it's your time. Blessings, you have 1 to 10. So pick a question from question number 1 to 10. And then we get going from there. Hello, blessings. Your speaker is on mute. I can't hear a single thing you're saying. You have to pick a question, blessings, from question number 1 to 10, and then we can get started from there. Yes, blessings, what's your question? All right, blessings, you're on mute. We can't hear you. You're on mute, blessings. Let's ask Memory. Memory, pick a question from 1 to 10.
Question 10.
Question number 10 says define impairment. Define impairment. You have 30 seconds. Twenty seconds remaining.
Impairment. This is
10,
This is a value.
5.
Ah,
Your time is up. Fantastic. So there we go. So memory kicks it with an egg. All right, that's fantastic. That's quite interesting. Impairment. There we go. Guys, I'm gonna go to someone else. Now we are going all the way to Cecilia. Cecilia, pick a question from 1 to 10, or you can answer the one that we asked memory. Should we ask you the same question or you need a different question? You're on mute.
Question.
A different question. Okay, so since you've chosen a different question, I'm going to explain impairment. Okay, we said impairment is the fall in value of an asset such that the recoverable amount is lower than the carrying value. You should feel sad about that question. I think it was the easiest of all questions. All right, so there we go. Fantastic. So we have another question here for Cecilia. Question number 10. Question number 10 reads, what's the difference between a contingent liability and a liability and a payable? What is the difference between a contingent liability and a payable? You have 30 seconds and it starts now. Ten, 15 seconds. 10 seconds. 5, 4, 3, 2, 1. Your time is up. Fantastic. Really? Fantastic. That's great. Cecilia also gets an egg. Oh, that's interesting. This is extremely, extremely interesting. This should be the most interesting thing I've seen tonight. So what we have is Cecilia here. Fantastic. That's great. Cecilia also joins memory with an egg. Okay, so let's go back to Joy. Joy, you have a question 1 to 10, or you can pick the same question that we asked Cecilia. You're on mute, Joy. We can't hear you. The same question
5.
or question number 5. All right. Question. So the one that we asked Cecilia, the difference between a contingent liability and a payable is that a payable is a specific liability that you know you're going to pay somebody. You know, if you owe me 1,000 kwacha, you are sure you owe me 1,000 kwacha. For a contingent liability, it's a possible liability whose occurrence is dependent upon the future outcome, either the occurrence or non-occurrence of a future event. That's the difference. So for a payable, you know, there's no uncertainty. For a contingent liability, there is a lot of uncertainties. You don't know a number of issues. All right, fantastic. So we go to Joy. Joy, question number 10. You said question number 10, right?
5.
Question number 5. Question number 5 reads. Question number 5 reads. What is the criteria for recognizing a provision? What is the criteria for recognizing a provision?
So, there's one measurement, then the recognition of the asset, and then the other one is
10 seconds. 5, 4, 3, 2, and 1. Fantastic. So that's incorrect. Thank you very much. So what we do, we go and give Joanne an egg. Okay, fantastic. There are lots of eggs this evening. All right. So far, nobody has gotten a correct answer. So Joy gets an egg, joins memory. Memory, you've led the team with eggs. Okay. So what we have now here, guys, we have a question to ask Daniel Schone. You can pick a question from 1 to 10, or you can choose to answer the one that we asked Joy.
Okay.
Daniel
I'll
Schone.
go,
Okay. Can you hear me now?
Yes, yes.
Okay. I think I'll go with the same one, that which Joy had.
Okay. What is
Okay.
the
So
criteria for recognizing a provision? You have 30 seconds.
okay. So the provision for recognizing a liability, number one, we need to establish, in terms of it, can it be measured with reliability, and then secondly, we need to look at, as it happened, as in the past, there is an occurrence which has happened, which will trigger for us to pay. So there will be probable outflow. So probable future outflow, past event which has occurred, and we can measure it with reliable in measuring. I think those are the criteria.
All right, fantastic. It's not very clear, so I'm not going to give you 2 points. Okay, I'm going to give you 1 point because you've touched things, but you're everywhere. But I'm going to give you a point. Okay, so I'm not happy with your solution, so I'm going to give you a point. I'm going to give you a point. Okay, because I'm not happy with your solution. Anyway,
Okay.
because you just touched a
Can
few
I
bits, so I'm going
attempt?
to give you a point. So Daniel Choni gets 1 point. The first point on tonight's session. Okay, fantastic. So a provision, guys, we said there are 3 ways of recognizing a provision, and we said number 1, all right, we gave out anyway. I don't think I'm going to give you 1. I'm going to give you 0. Okay, let me give you 0. I don't like how you said it. So let's give him 0. So Mr. Daniel, we give you 0. We change our mind. Okay. So
Can I answer?
let's
Can I
give
attempt as
somebody
well?
else.
Can
You
I
want to attempt the
answer?
same question? Okay.
Yes.
Let's go.
Okay. So there are 3 ways of recognizing a provision.
Yes.
So number 1, an entity is supposed to have a present obligation.
Yes.
Yeah. So this should be maybe legal or constructive. Then number 2, we should have a reliable estimate that can be made on the amount of the obligation. That's the second point on how provisions are recognized. And thirdly, we should also consider a component of the outflow of resource embodying to the economic benefits that will be
All
required to
right.
settle the obligation.
Okay. Anyway, that's what Daniel said. But anyway, I'm not very happy with that. But okay, I'm
Okay,
gonna give
sir.
you 1. I'm
Okay,
gonna give
sir.
you 1.
So you remove the 1 from me, but it is just the same. And if no, but okay, if away from the book definition, okay, I had to simplify it, because
Okay.
even if when you're making provisions, like as in practice, I'll
Yes.
give you an example.
Please do.
We are looking at it to say I've got this ZESCO bill, or maybe
Yes.
the consultants or audit that which we are going to incur in the following year. So
Yes.
I'm basing it on our past event to say, okay, how much did they charge us for the audit? For argument's sake, $10,000. So I'm basing it on our past event. So I'm going to provide for 10,000, which I am going to be accruing every month, because I know probably in the future it is going to work out. Whether we like it or not, it is statutory we are going to be audited. So basically, those are the 3 steps we were looking at.
Interesting. That's quite interesting. All right, guys. So there is a scramble for a point. Okay, I'm gonna give both of you 1 point, because I'm not happy with what you've said. Okay, so I'm gonna give you 1 point for coming back. But anyway, I'm not happy with what you've said, so I'm gonna give Daniel 1 point. All right, and I'm gonna give Mr. Lawrence 1 point. Okay, so you split the point, because I'm not happy with the way you've come out. Okay, I'm not happy with the way you've come out. That's not what I expected, but I'm gonna give you a point. All right. Usually, I wanted something more concrete. Okay, I wanted something more concrete. For example, when we talked about how we recognize a provision, I wanted something to be more concrete. Talk about the constructive obligations. It could be legal obligations, and then you explain to me what is the constructive obligation, what's the legal obligation, and then you get into those bits and pieces we talked about. I wanted something more concrete to make a layman understand what we are dealing with. All right. So anyway, I'm gonna ask a question on that one again. All right. So for now, guys, we move to the next person. So we have 1-1 on Lawrence and Daniel. But I'm gonna go to the other person. This time around, I'm gonna go to Mr. Hems. Mr. Hems, Mr. Hems, good evening, and pick a question from 1 to 10. Pick a question from 1 to 10.
Question 2.
Question number 2 says, explain the measurement of okay, I think there was a wrong spelling here. Let me just read again. It says under what circumstances do we? That's Mr. Hems. Question number 2. Okay, fantastic.
Yep.
I think I was reading a wrong question. Okay, fine. Let me just go back to scroll down up. This is question number. I was reading question number 12. Okay, fantastic. So, question number 2 says, how should a provision be measured? How should a provision be measured? That is question number 2. How should a provision be measured? You have 30 seconds and your time starts now.
Pass, sir.
Okay, fantastic. Right, pass. So Mr. Hems gets an egg. Fantastic. You are joining memory. Memory, you are the chair lady for eggs. You've led the egg scenario tonight. So memory is supposed to take responsibility for everyone else who is following your footsteps. So what we have Mr. Hems at an egg. And now let's get back to Mr. Mzamba. Mr. Mzamba, you can pick a different question or you can pick the same question that we asked Mr. Hems. Right? How should a provision be measured? So Mr. Mzamba, you can pick a different question or you can pick the same question. All right, Mr. Mzamba, I'm going to go to Mr. Mpundu. Mpundu, please pick a question from 1 to 10, or you can use the same question that your friend got.
Give me number 4.
Number 4, all right. So how a provision should be measured, let me answer that one before I go to number 4. We said, and we explained this very well in class, we said when measuring a provision, you're supposed to consider 2 things. Number 1, you're supposed to ask yourself, is this provision, is it a single provision or is it a plural or large, is it one involving larger populations? For a single provision, we said it should be measured using the best possible estimate, right? This is where maybe you've been sued by one client or one individual, then you go to court and then you ask your attorney to give you some advice on how to recognize, on how much to recognize, because your attorney has some experience from the previous dealings. Then they can advise you. They can make an estimate which is accurate for you. But for plural provisions, we said under this one, we use expected values, all right? We use expected values. So because there's another question on the expected values, and the measurement, I won't explain everything, but we said you can either use the best possible estimate if it's a single provision, or if it's involving a larger population, you can use the expected values. And we did some calculations here in class where we had one of the solutions giving us about 400,000 in provisions. But I'm not going to go into details because there's a question coming up on that one as well. All right, so question number 4 for Mr. Mpundu says, what is the question number 4 explains what is the difference between value in use and recoverable amount? What is the difference between value in use and recoverable amount?
Okay, value in use is the value of an asset as it is today. And then the other one you said?
Recoverable amount.
Recoverable amount is the amount that you are able to recoup if you are to sell that asset.
All right. Value in use is the value as it is today. It's not complete. It's not complete, Mr. Mpundu. All right, but anyway, I'm gonna give you one. I'm gonna give you one because of the value in use aspect. It's not complete. Okay, so I'm gonna give Mr. Mr. Mpundu one. Fantastic. That's good. Okay, good start. So Mr. Mpundu gets one. Okay.
Thank you, sir.
Who wants to get? Who's gonna go out with the money here, guys? Looks like you guys are competing for ones. All right, let's go to number 8. Okay, so number 8 we have Mr. Mzamba. You can come through. Mutale, your speaker. Mutale and Zikonde, you are not allowing the system to bring you on, and I can't help you. Okay, so all you do is allow. So let's go back to Cecilia. Okay, Cecilia. Mr. Mzamba has been logged out. Okay, Mutale is in the background and Cholwe is in the background. All right, Zikonde in the background. I can't bring you on board because you've not given permission to the system. You have to give permission, guys, for me to bring you on board. Okay. So let's go back to the one we started with. Okay, fantastic. So we have memory. Memory, pick a question from 1 to 10. Memory, pick a question from 1 to 10.
Question 10.
Question 10 says, define a grant. Define a grant. Mr. Wallace is happy with that question. He wants us to go to him. Define a grant, memory. What is a grant? And your time starts now.
It's a sum of money given by a government or other organizations for particular purposes. Yeah.
All right, fantastic. All right, I'm gonna give you one. Okay, I'm gonna give you one because it's not complete. It's on the middle, and I'm just gonna give you one. So memory gets a 1. Okay, guys. I'm not going to explain what a grant is for now because there's a question that is coming again similar to a grant. So I'll not explain it for now. I'll explain it after I've asked the other question. So I'm gonna go to second person. This time around, I'm asking Cecilia. Pick a question from 1 to 10. One to 10, Cecilia. Cecilia, you're on mute. Pick a question from 1 to 10. All right, Cecilia, we can't hear you. Pick a question from 1 to 10. And guys, please turn on your cameras. I need to be looking at you, okay? Question 1 to 10, Cecilia, you're on mute. Pick a question, please. Cecilia, question 1 to 10. Okay, let's jump Cecilia. Let's go to the next person. What Cecilia gets organized. Let's ask Joy. Joy, pick a question from 1 to 10.
Okay. Number 1.
Question number 1 says, what is the difference between a grant and government assistance? What is the difference between a grant and government assistance? Oh, that's a good one. What is the difference between a grant and government assistance?
Hmm.
15 seconds remaining. Ten seconds. 5, 4, 3, 2, 1. Fantastic. All right. There we go. Cecilia gets another egg. So just joy another egg. We go to Daniel Chone. Please, Daniel, pick a question 1 to 10, or you can answer the same question.
Question 5.
Question 5. So let me answer the one that Cecilia did not answer. So that Joy did not answer. So a grant, we said government assistance is action by government that is designed to provide an economic benefit. For example, we saw in 2021, early 2021 in March, President Lungu gave a tax relief to all of us. He said, those of you who've not been able to submit taxes, you've received a waiver. All right. So all of us had that tax relief. That is government assistance. Government assistance is an action that government takes. All right. Not to give you the money. They don't give you the money. All right. But it's an action that government takes that is designed to provide an economic benefit to specific entities or range of entities. All right. That are meeting certain criteria. So that is a government assistance. Well, a grant, on the other hand, we define this one as assistance by government in the form of a transfer of resources to an entity, all right, provided you meet certain criteria. So this is where the government gives you a transfer. But let me just go a bit technical here. When we said assistance by government in the form of a transfer of resources to an entity in return for past or future compliance, that you will not be able to pay back provided the conditions are met. That's a grant. For a grant, they give you, they say, okay, fine, Lawrence, you want to give it 10 million, but you're supposed to employ 5,000 people, locals in this location. You won't pay back this money if you meet all the criteria. That's the difference, all right? Government assistance, they don't give you money. They give you some sort of economic benefits, a relief to help you. For example, there's COVID-19, President Lungu did that. He gave us a tax relief. And I remember, was it Felix Mtati when he was minister? The one who gave us another tax amnesty. So those are government assistance. They don't give you the money, but they give you some sort of economic benefit to help yourself. So that's the difference. So question number 5. This is question number 5 for Mr. Of course, for Daniel Chone. Is that Daniel Chone? Yes, for Daniel Chone, question number 5 reads, and it says, what is the accounting treatment of grants related to income? What is the accounting treatment of grants related to income?
Okay, so grants that are related to income, you account for them when they are receivable. Okay, so, and again, I must also specify the concept of if you it has got a lifespan of more than, let's say, 1 year.
Okay.
There is so the double entry is you take it into deferred income account or deferred revenue, and you're only going to be recognizing, that's amortizing the portion which is due for that project.
All right. So in a short sentence, I just want to get this clear. What is the treatment of a grant related to income? Just a statement.
Okay. So you recognize it in the books when it becomes receivable and you have satisfied the condition.
All right. Fantastic. So okay, again, there's a keyword I'm looking for, but I'm gonna give you the points on this one. But I'm looking for a keyword. I'm gonna come back and explain because the question, so I want to explain. But the other part you've said is good, so I'm gonna give you the points. The first person to get the first 2 points, but I'm gonna come back and clarify on the reasons why I say I'm looking for something once I ask the next question. Thank you very much, Mr. Daniel. We go to Lawrence. Lawrence, pick a question from 1 to 10.
Question 3.
What is the difference between the capital approach and the income approach when it comes to grants? What is the difference between the capital approach and the income approach when it comes to grants?
Okay, so The capital approach, on the capital approach, we credit the grant directly to the shareholders' interest, while
Fantastic.
on the income approach, the grant is credited to the profit or loss over one or more periods.
You the
That's the
man,
difference.
you the man. Fantastic. You get all the 2 points. Fantastic. That's great. Okay. 2 points there. We go to Mr. Hems. Thank you very much, Mr. Lawrence. That's fantastic. Mr. Hems, pick a question from 1 to 10.
Question 10.
Question 10 says, what is the how do we present grants that are related to assets in the financial statements? How
Come
do we
again.
present grants that are related to assets? How do we present grants that are related to assets? Your time starts now. How do we present grants that are related to assets? Fantastic.
Help me. So.
All right, so there we go. Fantastic. So we pass Mr. Mr. Hems gets an egg. So we go to Mpundu. Mpundu, Mr. Mpundu can choose a different question or you can answer the same question.
Which ones are available now?
No, there are lots of questions. You can either answer the same question we asked Mr. Hems, or you can choose a different question from 1 to 10. Just choose a number.
Okay, 8.
Question 8. So let me answer the other one. So when it comes to presentation of grants related to assets, guys, we said there are 2 choices of how government grants that related to assets can be, presented. All right. And we said, number 1, you can set up the grant as deferred income. And then number 2, we said deduct the grant in arriving at the carrying amount of the asset. So whichever of these methods is used, the cash flows in relation to the purchase of the asset and the receipt of the grant are often disclosed separately because, remember what we said, because of the significance of the movement in cash flows. That's what we said. So those 2 ways, you can either set up the grant as deferred income or you can deduct the grant in arriving at the carrying amount of the asset. But either way, remember what we said, the cash flows in relation to the purchase of the asset and the receipt of the grant are often disclosed separately because of the significance of the movement in cash flows. That's what we said. Fantastic. So that's great. Okay, so question number 8. Question number 8 goes to Mr. Mpundu. Mr. Mpundu, what triggered the introduction of IS number 37 provisions? What triggered the introduction of IS number 37 provisions?
Let me just guess. What triggered provisions was that initially they were not being recorded in the financial statements. Then they realized that there's need to have them recorded in the financial statements.
All right. Okay. That gives you an egg. Fantastic. So what we said last time that financial statements must include all the information necessary for the understanding of the entity's financial position. And in the past, directors and preparers of financial statements would manipulate the accounts through provisions. All right. They can make a future provision. They can, use a dongoristic issue to cover up for their, incompetence and stuff like that. So the ISB saw it fit to bring into play IS number 37. So that IS number 37 can allocate the proper base of measurements and criteria to provisions, of course, contingent assets, contingent liabilities, and sufficient disclosures. That's what we said. So it is those issues that were arising in the past because of the, lack of honesty in those that were preparing statements to make them now be able to include all the information necessary for the understanding of financial positions by potential users and, of course, investors. So that was one of the reasons for the introduction of IS number 37, to make sure everything that must be included for the understanding of the company's financial muscle is added in the financial statement. Fantastic. So thank you very much. We go to Cecilia. Cecilia, pick a question 1 to 10. Pick a question 1 to 10. Cecilia, you are on mute. You have to pick a question from 1 to 10, Cecilia. And you know how to unmute your speaker. Just click that button like you did at first, and then we move on. All right. So I'm gonna jump Cecilia. I'm gonna go back to somebody else. I'm gonna go back to Memory. Memory, pick a question from 1 to 10.
Question 4.
Question 4 says, state 2 indicators of a possible impairment. State 2 indicators of a possible impairment. State 2 indicators of a possible impairment of an asset, and your time starts now.
Exchange rates, inflation, increase in the market interest rates.
All right. Okay. Yeah. Fantastic. Okay, let's go. So I'm gonna give you 2, but I would have loved if you explained something about interest rates. What happens when it comes to interest rates? You're stating, not explaining in details, but just to state briefly. For example, you say increase in market interest rates. When you talk about inflation, how does inflation affect impairment? What happens for inflation to become an issue? So that a layman can understand possible indicators of impairment. But then I'm going to give you all the points because we've mentioned the things that are there. So Memory gets all the points here. Fantastic. Let's go to Joy. Joy, pick a question from 1 to 10.
Question 7.
Question 7. What is the difference between current tax and deferred tax? There's feedback from your end, Joy. If
Hello?
you have another phone that is working, please mute.
No, there's no phone that's working.
Okay, fantastic. So what's the difference between income tax and fair tax? Your speaker must be on.
Can you hear me?
Your camera must be on. Yes, there we go.
Is my camera on now? I can't see.
Your camera is not on. Okay, now you're back.
Okay, yeah. So, read to the question, sorry.
What is the difference between income tax and deferred tax?
So, deferred tax, this is a tax.
That's the wrong question. What is the difference between the current tax and deferred tax? Yes,
Okay,
that's the question.
Current tax, this is the tax that's payable or receivable in that period. Then deferred tax is the tax that is supposed to be paid at a later date.
Fantastic. Okay, so you get the 2 points. Joy.
Thank you.
Okay, fantastic. So guys, mute your speakers. I'm getting some feedback. You on and mute if you want to answer a question, people. Please mute your speakers. Okay, fantastic. So there we go. All right, so Joy gets the 2 points. So we go back to Mr. Mzamba. Mr. Mzamba, pick a question from 1 to 10. Pick a question from 1 to 10. Okay, so Mr. Mzamba, all right, fantastic. So I'm going to jump Mr. Mzamba. Mr. Mzamba has been kicked out. Okay, so I'm going to go to someone else. Mr. Mzamba, I'll jump him. So I'm going to go back to Daniel. Mr. Daniel, pick a question from 1 to 10.
5.
Question number 5. Okay. Explain the situations that may lead to deferred tax. Explain situation that may lead to deferred tax.
Okay, so number one scenario is where the company has got a policy when it comes to the depreciation of an asset, and also
Okay.
there is a tax aspect side of it in measuring the rate at which they are charging the tax written down value. Okay. So in this situation, we are going to have the carrying value when we are doing on the accounting side, where we cost, maybe for example, we apply 20%. If it's a straight line method, then we are lessing it from the cost to get the carrying value. And maybe on the tax side, they are applying a 50%, which is accelerated. So we are comparing our carrying value with the tax value. So the difference between the two can be either an asset or a liability which is due to the authorities, in the sense that if the authorities accelerated it was at a higher rate, definitely in the later stages will be in a payable position because I will be owing them. So that is one situation that leads to deferred tax. And then the other component also has to do with the revaluation. If there is an increase in the value of an asset, that revaluation is subject also to deferred tax. There is also, if you are dealing with exchange differences, there is a component of the unrealized component, which we haven't yet paid, also leads to deferred tax.
All right, fantastic. I'm beginning to like you a lot, Mr. Daniel. All right, fantastic. So let's give Mr. Daniel another point. We'll give you 2 points. So Mr. Daniel, thank you very much for that. And I'm just going to add on what Mr. Daniel has said, okay? For a layman to understand, deferred tax, like Joy said earlier, it is a tax that you pay at a future date. Now, let me explain this so that you can understand where we're coming from. Like Mr. Daniel has said, that's very good, Mr. Daniel. Keep up the good work. So guys, what we have, when you're an accountant, all right, you make a sale. The accounting rules tell us that we are supposed to prepare our statements on the basis of the accruals concept. That means we recognize revenues and expenses when they are earned or incurred, not when they are actually paid for or received. So when you sell to somebody on credit, you as the accountant, what do? You record a sale, all right? And on that sale, you make a determination of the tax you're going to pay. But when the taxman comes to tax you, he says, hey, dude, I'm not going to tax a number on a piece of paper because what you have here, you have sales worth 100,000, but you've not received any money. You have a number. So I can't tax a number. I'm going to wait for you to receive the money, and then I'm going to tax you on the money. That's the situation that may also lead to deferred tax. So what you do when you make some profits, you are going to show on the SFP under non-current liability and current liability to show the shareholders that actually we have a liability that is pending on deferred tax. So that may be another scenario that may trigger the deferred tax aspect, partly because you have the sales today which are on credit, you've not received the money, but you've recorded the sale because of a accruals concept. But the taxman says, I'm not going to tax a number on a piece of paper because the profit is not money. Profit is a number on a piece of paper. And the taxman saves you the headache of taxing a number on a piece of paper. He says, okay, fine, I'm going to tax you when you receive the money. That's a good one. Fantastic. Okay. So we go to the next person. We go to Mr. Mzamba Richard. Mr. Mzamba, pick a question from 1 to 10. Mr. Mzamba, pick a question from 1 to 10. Okay, I can't hear that, so I'm going to go to someone else. let's go to Mr. Lawrence. Mr. Lawrence, please pick a question from 1 to 10. Mr. Lawrence, pick a question from 1 to 10.
Question number 8.
Question number 8 reads, define tax base. Define tax base.
Okay, pass.
Really fantastic. Somebody is happy that you've passed that one. Tax base. Guys, you feel sad right now about that, right? Yeah, I see you feel sad, Mr. Lawrence. That should be one of those questions you say, you know what, thank you very much to ask me this one. It will never come in the exam like that to us to define what tax base is, but the examiner can give you to work out calculations involving the tax base situation like we did in class. All right, fantastic. So I'm going to go to Mr. Hems. Mr. Hems, do you want the same question or a different question?
Different questions.
Different question. So guys, tax base is the, you know, like we did in class. Let me just give a scenario, okay? Let me explain a scenario for you to understand. If let's say a company has assets worth 10 million, all right? I don't want to define that. I want to explain so that it makes sense. Let's say a company has okay, Madam Zikonde, let's mute her speaker. Okay, good. Let's say a company has got assets worth 10 million. All right? That's the company, assets worth 10 million. And then the authorities say that no, this company's tax base is 6 million. What that means, it means that 6 million worth of assets will not be taxed. We are going to remove the 6 million and then tax what remains. All right. So the value of assets that are exempted from tax purposes, the one that fall under the category of the tax base. So if you have a company with 10 million assets and 6 million of those is referred to be the tax base, that means you're supposed to remove the 6 million first and then tax the difference. Right. So just so you know, so the tax base, they represent the level of assets that are exempted from tax. That will not be able to tax when we are working out tax computations. All right, guys. So let's move on. Let's move on. So what we have. So Mr. Lawrence, you feel bad, right? That must be hard to swallow. It was so easy. All right. So let's go back to Mr. Hems. Oh, Mr. Hems, you picked which question?
Question number 10.
Question number 10. Okay. Let me just open this one up. Okay, fantastic. Question number 10. What is the difference between a legal obligation and a constructive obligation in relation to IS number 37 provisions? What is the difference between a legal obligation and a constructive obligation in relation to IS number 37 provisions? Your time starts now.
Okay, so a legal obligation, these obligations where you are mandated by law. For example, if maybe an institution is taken to court, you provide for the you create a provision for the amount you're supposed to pay for the lawyers, for example.
Yes.
Then for a constructive provision.
Yes.
Yeah, that one I've forgotten.
All right, fantastic. So I'm gonna give you one. Okay? Because you said something very true at the beginning. I'm gonna give you one, Mr. Ames. I'm gonna give you one. So guys, let's explain the difference. So I'm giving you one. Thank you so much for that. So guys, the difference here between a legal obligation and a constructive obligation in relation to IS number 37 provisions is this. A legal obligation is what Mr. Ames has said. When somebody has sued you, all right, a client has taken you to court, what you have is a legal obligation because somebody has taken you to court and possibly your lawyer tells you it's going to cost you 10 million. You have a legal obligation. A constructive obligation is what a lot of people do. It is due to conduct. It is based on the past dealings. So like, for example, if you have a boy from the neighbor, right? Every time you call him to come to your place, you send him to go to the market, he comes back, you give this boy 100 kwacha. at a very short distance. Tomorrow he comes back, all right? Go and fetch water for me. He goes, there's water for you. You give him the squatcher. The next day he comes back. You send him to go and buy tomatoes. He comes back, give him the squatcher. What you are creating there is a constructive obligation. It's not an obligation where you sign anywhere, but it is the one that is implied through your conduct or your past dealings. So if this boy comes for the 6th time and you give him 50 kwacha, he has the right to refuse. Say, you know what? Give me 100 kwacha. You can't say, no, I just give you 100 kwacha because I'm nice. No. It's because through your past dealings, through your conduct, you've made this boy to reasonably believe that his services to you are worth 100 kwacha. That's a constructive obligation. If you are dating somebody, for example, you have a constructive obligation. 1 year, 2 years, even though you've not proposed marriage to them, they are going to assume that you want to marry them because of your conduct. You tell them you love them and you are dating this person. So that's a constructive obligation. You can't say, I did not propose. No, you don't have to propose. What you are doing is resulting into an agreement. There are people who are married to people they never proposed to. They were just friends in school and they became close, and one day a ring was given without having to propose. Constructive obligation. Due to your past dealings and conduct, okay, I think I didn't tell we are dating, but you've not proposed. Constructive. All right, so that's the one. Okay, fantastic. Okay, so let's go to the next one. The next one is, okay, Mr. Richard Mzamba, pick a question from 1 to 10. All right, so I'm going to jump, Mr. Richard. I'm going to go to memory. Memory, pick a question from number 1 to 10.
Question 6.
Question number 6. Question number 6 reads, what is, okay, what is the meaning of the term restructuring in the context of IS number 37 provisions? What is the meaning of the term restructuring in the context of IS number 37 provisions? All right, so you have 15 seconds.
Pass.
All right, fantastic. So there we go. So memory gets an egg. There we go. Okay, so we have to go to Cecilia. Cecilia, pick a question from 1 to 10. Okay, I'm gonna have to jump you, Cecilia. I'm gonna go to someone else. Okay, I'm gonna go to someone else. I'm gonna go to Joy. Joy, pick a question from 1 to 10. Yes, Joy, question 1 to 10. I will not explain the meaning of the structure in the vice numbers because it's a question that comes to that. So once I answer the other question, then I'll explain it. So yes, Joy, question 1 to 10, which one are you picking? You're on mute, Joy, I can't hear you. Okay, Joy is on mute. I'm gonna jump Joy. I'm gonna go to Mr. Daniel. Mr. Daniel, pick a question from 1 to 10.
5.
Question 5. What is the difference between restructuring and onerous contract?
Okay, so onerous contract, I think this is the contract where it is kind of unavoidable.
Okay.
As it happened in the past, and you have no way out of it but to the outflow will be, you have to pay for it. Then if we talk of restructuring, I think restructuring obligation, it is a plan where the management or an organization which they are likely to execute, and for it to be effected and to provide for it, it has to be communicated to the people who be affected. Then at that point, it will only involve the costs that will include the restructuring.
Fantastic. That's very true. But I want to ask you a question before I give you the 2 points. Why is a owner's contract unavoidable?
I'll give I think it is more of a sunk cost in nature, if I was to put it like that, because it has already happened, and you cannot reverse the events that took and caused that obligation to be due.
All right. Okay, fantastic. I'm going to give you the 2 points, but let me explain why a owner's contract can be. That's good, Mr. Daniel. Thank you very much for that. So there you go. Guess the 2 points. So guys, the owner's contract is usually unavoidable because it's a must. No, it's not. I wouldn't necessarily say it's a sunk cost. This is a contract that is more like a lease, for example. If you enter into a lease and then COVID-19 pops up, you don't have the money to keep on operating, but the penalties associated with you canceling that contract are so huge that you have no choice but to continue the contract. That's what you call the owner's contract. It's a contract where the penalties of terminating are more than the benefit of terminating. So in the end, you're not working, but you're still paying rent to your landlord because you are scared if you leave the building, you're going to pay huge penalties that are going to make you bankrupt. So in the end, you just get stuck. Remember that, Mr. Daniel? Fantastic. That's a good one. Thank you very much. So Daniel gets the 2 points. That's great. So we go to Mr. Lawrence. Pick a question from 1 to 10.
Question 4.
Question number 4. Question number 4. Okay, let me open this one up here. Let's go and pick question number 4. I'm going to need to open this thing up. I'm on question number 24. So I have to scroll down to question number 4. Explain the treatment. Anyway, I'm not sure you're going to answer this one, but I'm just going to ask you. Okay. Question number 4 reads, explain the treatment of depreciation when dealing with deferred tax. Yeah, it's not difficult. Yeah. Explain the treatment of depreciation when accounting for deferred tax. Explain the treatment of depreciation when accounting for deferred tax. Yeah, I remember we talked about this a lot in class. It's going to be nice. I'll be happy to laugh at you now. Let's go, Mr. Lawrence. Explain the treatment of deferred depreciation when accounting for deferred tax. And your time starts now. All right?
Hello?
Yes.
Pass.
All right, fantastic. So I'm going to pass. But because there's a question that is linked to this question, I won't explain that now. I'll explain in the next question. So let's go to Joy. Joy, pick a question from number 1 to 10.
Number 6.
All right. So question number 6 reads.
Is it because of my
State
mic?
2 types of assets. There's a lot of feedback. That's from Madam Zikonde. Why are you unmuting your speaker when we mute you? Please mute your speaker, Madam Zikonde. Do not unmute. Okay. So question number 7 reads, Joy. Give 2 examples of assets that you must regularly check for impairment, even though there is no indication of impairment. State 2 examples of assets that you must keep checking for impairment regularly, even though there's no indication of any impairment. 2 assets.
I forgot it.
All right, fantastic. So Joy gets an egg. Let's go to the next person and see if they can pick the same question. Mr. Hems, do you want the same question that we asked Joy, or you want a different question? 2 assets that you must regularly keep on checking for impairment, even though there's no possible impairment. Do you have 2 types of assets that you must keep checking for impairment, even though there's no possible impairment?
I just want to try.
Okay, fantastic.
One of the assets is goodwill.
Okay.
Yeah.
The second one?
The second one, pass. Second one.
All right, I'm gonna give you one. I'm gonna give you one. Okay, so I'm gonna give you one. Yes, goodwill is one of the assets where you must keep checking for impairment, even if there are no indications of impairment. Right, goodwill must always be checked for impairment. And the other one, these are intangible assets with an indefinite useful life. These you must keep checking for impairment, even though there's no possible indication of any impairment loss. All right, so I'm gonna give you one. Okay, fantastic. So we go to Mr. Mpundu. Mr. Mpundu, pick a question from number 1 to question number 10.
3.
Question number 3. Explain 2 internal sources of information that may indicate an impairment loss. That may indicate I think there was supposed to be a word between, but anyway, it was typing error. Give examples of 2, of course, examples of in terms of information that may indicate an impairment.
I think number 1, just guessing, the asset register.
Okay.
Yeah, then the second one, the second one sources like change in technology.
Fantastic. So change in technology, that's an external indicator of of an impairment. If you're using analog and then there's digital, change in technology, that's external. Internally, one of them we said it could be obsolescence. Obsolescence. We talked about expiry dates. Remember those expiry dates? We talked about expiry dates. If something expires, you are saying something has expired. Of course, that has been impaired because it's expired. You see in ShopRite, if you go there, you throw some apples, oranges because of expired, including bread. All right. So we also talked about physical damage to the asset. The asset is physically damaged. There's an impairment because it's damaged physically. You can see it. All right. But also we talked about, I gave you an example of a company I worked for some years back in Kafue, where we had a bagging machine that was analog, and then they bought a digital bagging machine. So changes also in the use of an asset may also indicate impairment. Internally, you change, the use. You no longer use the asset for this particular purpose because you have something more advanced or something better, or maybe just the change in the test. All right, fantastic. So, guys, this was, of course, a brief quiz for tonight. Okay, it was a brief quiz, and thank you very much for coming through. So let's look at your results. Okay, let's look at your results and see our winner for tonight. Let's look at your results and see our winner for tonight. All right. Okay, so there we go. Okay. We're supposed to be 20 something here. But anyway, some people are not here. There are people with a tendency of running away from a quiz, and will not entertain that. There are going to be consequences. All right, fantastic. So guys, thank you so much for what you have done. What you have done is amazing. So whether you've gotten the maximum points or not, you've won. part because now you know where you're behind, and now you know what you're doing and what you're supposed to be doing. That's the most important part, because now you know that, you know what, for now there's no. So there we go. So the winner for tonight's quiz is Mr. Let me just share the screen with you. Okay. Let me share the screen with you so that you can look at these numbers here. There we go. So what we have Mr. Hems gets the number one. Mr. Daniel is at number one with 7 points. And then we have two people at Memory at 3 points. And we have, of course, Lawrence at 3 points. And then we also, oh, look, this is interesting. We have Joy at 3 points. And then we have Mr. Ames at 3 points. Then we have Mr. Mpundu at 1 point. And then we have Cecilia at 0 point. And we have Richard at 0 point. Then, of course, we have Zikonde at 0 point. So, of course, some of you I did not write you because you've been in and out. So, yeah, so we have all these people at, of course, 0 point and stuff like that. But anyway, so there we go. Yeah. So this is number 6. Okay, great. So, guys, thank you very much for coming through. So the winner is Mr. Daniel. Mr. Daniel is gonna walk away with a prize from the class. Okay. So this is the winner of tonight's money. It's gonna be Mr. Daniel. So in our next class, Mr. Daniel, you get paid when we meet on Wednesday. That's fantastic. Okay. That's fantastic. So guys, just to give you a reminder, we meet again on Wednesday. We meet again on Wednesday, and we're going to be discussing something very fundamental. We are going to be doing one of the big standards on Wednesday. We're going to be doing leases. So if you've not yet enrolled for the June or September or December, feel free to contact us at 0953 979798. That's the number you can reach us on. So we are starting a very, very big standard, of course, on Wednesday. We are starting leases, extremely examinable and very, very important. So guys, thank you very much for coming through. Thank you, Memory, for coming through. It's always a pleasure to have you here. Thank you so much, Mr. Chimba, Mr. Mpundu, Daniel, Mr. Lawrence, Chorwe. Thank you for coming through. Joanne and everybody who joined us, our ever-loving audience. Thank you very much for showing up and for participating. I see some questions in the comments. I wish I could read all of them, but unfortunately, I'm unable. Yes, you are right. You are right. Bernard, tax base is the value that tax authorities attach to the value of asset for tax purposes. Yeah, that's a very good try. Yeah, you're right. Actually, that's good. So there we go. Okay, you can inbox us at 0953 979798, and we'll be happy to discuss with you. All right, guys. Thank you very much for coming through. I wish I could go through all the comments, but I'm unable to do that for now because of time. So guys, have a good night. May God be with you guys. I'm so happy that you came through. I'm gonna see you in our next class. So for now, it's bye-bye from me. See you in our next class on Wednesday.